Hi there, my name is Jason Ayers, Director of Business Development with the Croft Financial Group and a member of the Investment Review Committee. On behalf of the committee, thank you for taking the time to watch our monthly review and commentary for February 2019. While January offered significant relief for investors as both U.S. and Canadian stock markets regained a portion of what was lost to the uncertainties of 2018. The welcome reversal was driven by two main catalysts. First, stocks were oversold and had approached significant long-term support levels. These technical levels tend to encourage short sellers to buy back equities to cover their positions and lock in profits. Investors also come off the sidelines to take advantage of the opportunity to buy their favorite companies at what might be considered a bargain based on valuations. Second, the U.S. Federal Reserve stepped back from raising rates, taking a more wait-and-see stance and easing investors' fears of an impending recession, at least for the time being, a move that surprised many. All things considered, both U.S. and Canadian stock markets were largely driven by negative headlines and the resulting uncertainty in the fourth quarter of 2018. With January's headlines being relatively positive, or at least not quite as negative, market sentiment shifted to a more risk-on mindset. For the month of January, the S&P/TSX, Canada's main index, added 8.74%, bolstered by its weighting towards a recovering energy sector, as well as a whopping 43.3% jump in healthcare, thanks mostly to cannabis stocks. The S&P 500 on the U.S. side added 8%, influenced by a pause in interest rate hikes, better than expected earnings, a jump in industrials, as well as an impressive rally in the energy sector based on OPEC's agreement to cut production. Moving on to fund performance, the equity fund finished the month of January up 8.22%, while its benchmark, the TSX Total Return Index, gained 8.74%. This, of course, also reflects the year-to-date numbers. As discussed in last month's commentary, the fund has been repositioned to be more defensive, accomplishing January's recovery while holding 30% cash and two hedging positions on the S&P 500 and NASDAQ indices. Many of the underperformers were purged from the portfolio and profits were locked in on the outperformers. The investment committee has been paying close attention to the latest round of earnings reports. The performance of a company in the previous quarter's economic conditions and how they communicate their expectations moving forward, known as forward guidance, have a significant impact on the share price and is a metric that influences investment decisions. So far, the earnings numbers have been tamer than expected. While there have been several bottom-line beats, fewer companies are beating on revenue expectations, and the profit guidance from management has been lower than in the past. While we will continue to capitalize on any upside opportunity, this further reinforces our expectations that 2019 is going to be a challenging one for stocks. Given our expectations, the equity fund will continue to remain defensive by raising cash, moving into securities with quality and low volatility attributes, and using additional option strategies that are more suitable to reducing downside risk in the current market environment. The income fund gained 3.19% in the month of January compared to the Financial Post Index Income Benchmark, which was up 2.64%. This also reflects the year-to-date returns. The investment committee took significant action to provide stability for what is projected to be a turbulent 2019. The fixed income exposure within the fund was increased to 55%. Within this fixed income allocation, the preferred share exposure was reduced from 20% to 15%. This adjustment was accomplished by selling the entire exposure to the preferred share ETFs that had exhibited significant volatility last quarter. Less volatile individual preferred shares now make up this component of the fund. Convertible debentures were increased 6.4%, up from 3%, by adding two new positions, Fiera Capital and Ag Growth International. The fund initially held the Ag Growth International stock, but switched to the convertible debenture, which provides more stability, but still participates in long-term upside opportunity. Sector exposure transitioned to lower volatility holdings in utilities, telecom, and healthcare, while reducing exposure to higher volatility sectors such as information technology and financials. The fund closed out Facebook, Alibaba, Micron, and added a hedged QQQ option strategy that profits from the time decay of short-term put options. The QQQ is the ETF that tracks the NASDAQ index. Healthcare exposure was also increased to 8.55% by adding Danaher Corp and Medtronic. Estee Lauder was added to the consumer discretionary exposure with a long-term put to protect the position in the event of another market sell-off. The covered call position on the gold sector was also reestablished. Gold companies traditionally increase in price during market downturns as investors look for safe investments. As for our current outlook and expectations, we continue to maintain our view that despite the recent correction, the U.S. secular bull market is still intact, as evidenced by this weekly chart of the S&P 500 showing support along the 200-week moving average and associated trend line from the 2009 low. However, as stated last month, the economy is in the mature phase of expansion and market fundamentals are late cycle. Certainly, the Federal Reserve backing off on future rate hikes and taking a more wait-and-see attitude has had a significant impact on investors' risk appetite. This move has made current company valuations appear even more attractive and has turned investor sentiment from fear to greed, at least for the short term. All that considered, geopolitical risks and concern for slowing global economic growth remains as a significant undercurrent. We continue to expect 2019 to be a volatile year for stocks, and as such, we will maintain a defensive stance relative to each of our fund's objectives while remaining positioned to capitalize on any movements to the upside. The tactics employed include actively trading our equity and options positions to lock in profits, holding higher allocations to cash and fixed income, as well as managing a more active hedging program.